So, as I think everybody heard, my name is Erin Sears, and I currently am the Business Risk Management Advisor for Nova Scotia. This is a term position for the rest of ASCAP. So I'm here located in Nova Scotia to kind of help support producers with any questions around the Business Risk Management suite of programs. So I know that the webinar was called Feedlots and Financing. So business risk management isn't really financing like you would with a traditional bank or APP that Kara will be talking a bit about. There are four main BRM programs available with agriculture businesses nationally. Participation in these programs is voluntary, and it includes a producer portion as well as a cost share portion. So with the cost share, it's 60% federal and 40% provincial. So in the suite of programs, there's AgriStability. It's going to be the main one I'm talking about today. It's a margin-based program that provides support for larger income declines. Benefits are based on a decline in your firm's current year margin, which we refer to your program year margin, compared to your historical reference margins. So it is a whole firm program. So what that means, it looks at all the sources of farming income, and it's considered in that classification. So I know that there's a lot of farms that are in Nova Scotia that do beef farming as well as other commodities. I think Bert mentioned he's also doing fruit growing. So it looks at all of those commodities, not specifically just beef. So to participate, a producer must have been farming in Canada during the program year and be reporting farming income or loss for tax purposes. Must also have completed at 6 months of farming activity and a production cycle. So we're going to go into more detail later on about that program. AgriInvest is another program that I'll be talking about, and it's a producer savings account. These two programs are administered through Agriculture Agri-Food Canada out of Winnipeg. So that's why my role is important, where we have that local connection and support. Agri-insurance is administered here in Nova Scotia by the Nova Scotia Crop and Livestock Insurance Commission. It is a production insurance, and there are different programs for different commodities. If you're interested in production insurance, you'd want to talk to the crop insurance for like the cropping side. I know there's a new LPI program that I think Kara might be able to touch on later on. Agri-recovery is also included in this business risk management framework. And it's not a program, it's more of a framework which forms the basis where federal and provincial government can work together when a natural disaster occurs to assess and determine whether there is a need for an initiative, and then work on putting that initiative together for the province. And agri-recovery focuses on extraordinary costs, not the production losses that the other programs would support. So these four programs, they're designed to work together to help protect your farming operation. So let me dive into AgriInvest a little bit more. So AgriInvest, as I said, it's a self-managed producer government savings account designed to help manage small income declines and make investments with your operation. So producers can make an annual deposit into their AgriInvest account and receive matching government contributions. So I'll dive into a little bit more, but basically you can put 1% of your allowable net sales into the account, and then the government will match that 1% as well. So yearly contributions are based on allowable net sales. So calculating those allowable net sales, it's commodity sales minus commodity purchases. There is a minimum deposit of $250, and there is a government maximum contribution of $10,000 annually. So I'm going to go over a quick example, but if you have questions, if your farms are not in AgriInvest and you want to go over your specific scenario, I'm happy to kind of sit down and do the math with you. So total sales of eligible commodities, so let's say that these would be beef sales, are at $250,000 for the year. Less purchase of eligible commodities, so let's say you purchase some feeder cattle for $30,000. So your allowable net sales in this example is $220,000. So you can put the full $220,000 in the account, but the government will only match the 1%. So most producers put the 1% in to get the matching government contributions. So the 1% in this case would be $2,200. So deposits must be made by the deadline on your deposit notice. Typically, you have 90 days to do that. One thing that I'm realizing that a lot of producers don't know about is only one deposit per deposit notice is allowed. So once a deposit is made, a participant can't get further matching government contributions. So it's really important, whatever is on that deposit notice, to put that in the first time. You can't do multiple deposits to get and take advantage of the government contribution. So the interest rate is made up by the financial institution. So most people, if you don't already have an AgriInvest account, they would set that up at their bank. But it is good to kind of ask about what that interest rate is, because all financial institutions are slightly different. And once you're in the program, AAFC will send a producer an annual statement of account showing a summary of their accounts for the year. So before I move on to AgriStability, is there anybody who has questions around AgriInvest? I don't see any hands, so I'll keep on going. So AgriStability protects Canadian producers against large declines in farming income for reasons such as production loss, increased cost, or market conditions. And AgriStability is a margin-based program to help producers manage those large income declines. So I think the biggest takeaway here is we're going to go over how the margin is calculated, but keep on the back of your mind that this is for large income declines. So AgriStability provides income protection based on an annual production margin. So in order to really understand the program, you need to understand how that margin is calculated. So a production margin is equal to your allowable income minus your allowable expenses. So your allowable income generally includes all the commodity sales and certain program payments. So since we're talking about beef, those would be your beef sales, semen sales, breeding, anything to do with those commodity or commodity sales. And then certain program payments. So if you do have crop insurance and received a payment, then that would also be an allowable income. Allowable expenses are those that capture input costs directly related to the production of that commodity in a given year. So example would be fuel, if fertilizer for your crops, to feed your cattle, seed, feed for the cattle, and arm's length salaries. But they do not include capital costs, such as land and equipment. One of the ones I also get is custom work. So if you have somebody coming in and spraying a crop and stuff like that, custom is not eligible under those allowable expenses. So both the program year margin and reference year margin are subject to a series of adjustments to make things fair, because as you know, things can change year over year. So as a producer, you have two options for reporting your income with CRA. One is either cash or accrual. So most people file cash. So this program works off cash. So there's accrual adjustments that need to be had to really reflect what's happening on your farm during that given time. So those would be those accrual adjustments with crop inventory change, the accounts receivable change, or purchased input change. They really want to isolate those changes and make sure that their calculation is reflecting that. So the current production margin, which we refer to the program year margin, is compared to an average historical production margin, which we refer to as the reference margin, to determine if an income decline has taken place. So let's just go into the next slide, which kind of talks about how the reference margin is calculated. So as noted before, the program works by comparing your current year production margin to your reference margin. The reference margin is calculated using an Olympic average of the previous 5 years, or an average of 3 years if you don't have that 5 year of history. So Olympic average drops the highest and lowest years, and then the average is the remaining 3 years. Again, if you're a new producer and you don't have that, then they would look at that 3 year history. Or if you don't have the 3-year of history, the administration creates those missing years using industry average benchmarks. So both the program year margin and reference margins are subject to a series of adjustments, which we already kind of talked about with those accrual adjustments. But you can see right here that they dropped the low, they dropped the high, they took these remaining 3 years, which are referred to your Olympic average, to equal them out to get that reference margin. So this here is an example of kind of what the whole program looks like. Hopefully you can see my my clicker, but here you're taking those 5 years of history, you're dropping your high, you're dropping your low to get those 3 years remaining, and this is reflected on your reference margin. So this example, let's just say you have $100,000 that is for your reference margin. In order for this program to trigger, you need to have a reduction of 30%. So in this case, that would be $30,000 reduction in order to trigger a benefit with this program. So like I said, this is for larger income declines, not small income declines. So in this scenario, let's say your production year margin, you drop 75%, which in this case would be $75,000. So the program is designed that for your first 30,000 or 30%, that would be something that you would be managing on your own. And the remaining 45% of 45% or 45,000, you would be able to get a benefit for that. And it's right now 80 cents per dollar. So you'd get $36,000 in this scenario. So with AgriStability, it gives you a broad coverage, as there are many reasons why your production margin can change. So I have on the spread or on the slide listed some of the examples, but I'm going to go specifically and just talk about some of the beef examples. So let's say your feed cost increase. So if there's a significant rise in the cost of feed, especially during critical periods like winter feeding or drought conditions, it can lead to higher expenses and reduce your margins and could trigger a benefit. There's also that market price decline. So a sudden drop in market price for cattle, whether due to oversupply or external market factors, can directly impact the profitability and reduce that margin. Another example would be health issues. If there was a disease outbreak with your herd, then you could have increased veterinary costs. You could reduce your productivity, leading to those lower margins. And then vice versa, there is options for margin increases as well. So let's say you've been managing your herd very well and you've been improving the genetics. So investing in high quality breeding stock or genetic improvements can lead to healthier, more productive cattle, which could increase your overall output and margins to increase your income. So I didn't talk about structure change and when I was going over kind of that production margin calculation, but I had a little star on the slide. So from time to time, farming operations size may change. So that could include expanding acres, reducing acres, producing a new commodity. It could be increasing your herd, change of ownership. So AgriStability uses a mathematical formula to adjust your reference margin up or down to reflect these changes. So really, when I think of structural change, I think about they're really looking at comparing your current production margin to like apple and apple comparison. So they want to make sure that those 5 years of history is kind of at that same production that your production or your current year is. So there's 2 different ways that the feds do that calculation. And I'm not, due to time and stuff, I'm not going to get into the weeds on that, but there's the ratio method and additive method. And the ratio method is the one that is most common. So in both of them, there is a benchmark per unit which is your margin to do those calculations. So I think it's important to know what a benchmark per unit industry or benchmark per unit is the industry average for one productive unit of a given commodity for a specific region. So it's important to kind of know that each production unit has a benchmark, a BPU, to kind of reflect what's happening here in Nova Scotia. And it's the difference between your allowable income and your allowable expenses yeah, sorry, rambling. Okay, so I'm going to go specifically into, I guess the beef sector. Sorry, I have this cold that just keeps on giving. So the program works differently for the different production options. So I know here in Nova Scotia, there's some overlap, but when you look at kind of like those production options, you have your cow-calf, where you maintain a herd of cows that calve annually. Calves are raised to wean in age and then sold as feeders. Then you have your backgrounding or feeder operations, where they're buying those weaned calves and they're growing them up to a certain weight, and then they're selling them to feedlots. And then you have your feedlot or finishing operations that are raising the cattle to the processing weight and then selling them to local processors or other sales channels. But basically, it's going to the consumer. And I know that there's some operations that are kind of in each one of them, but it's important to kind of know how the program works a little bit different for each one, or has larger benefits, I guess, for depending on the risk. So for the business model, there's also different business models. I think most farms in Nova Scotia use the first one, the own the feeders, you are backgrounding and finishing. But there are some places that don't own the animals and they're offering a service, and both of them can get support through AgriStability and AgriInvest. So let's look at the cow-calf operation first. So for AgriInvest, this production option generates eligible farm income through the sale of the calves. So that was kind of that AgriInvest example that I used at the beginning. You have your steady annual revenue for calf sales, so it makes it easy to kind of contribute to AgriInvest on an annual basis. And most of the time, that number is pretty steady, unless you're growing or like expanding your herd or decreasing your herd. So producers can use AgriInvest funds for what they want. So as soon as the government gets their matching contribution into the account, you can take the funds out at any time. So you could use it for herd improvements, or you could use it for helping with cash flow if there was unexpected vets, or if you needed cash flow because there was a market downturn. So those are just kind of examples, but once you have AgriInvest money, you can do what you want with it. But we're encouraging you to reinvest into the farm because that's the intent. AgriStability is suitable for mitigating risks like poor calving rates, low weaning weights, or market price drops. And income can vary year to year due to feed costs or reproduction issues. So AgriStability could help smooth that out a little bit if you had a substantial decline due to those reasons. So with backgrounding and feeder operations, so again, the eligible income would be the sale of those feeders. So margins can be tighter with this operation. So AgriInvest again can be used to help kind of with that cash flow or that buffer once you have it built up, or maybe you want to just take it out each year and add it into the cash flow of your operations. AgriStability, so this production option carries more market volatility. So you could be in a position where you're buying high and selling low. So with AgriStability, kind of the higher risk that you have, there's potential a higher benefit through this program. So feed price spikes, weight gain issues, or animal health problems can cause those margin declines, and AgriStability could look at helping with some of those problems. So with the finishing operations, so again, you have large volumes of income when you're selling those finished cattle. So you typically would have a good amount of money that you're able to go into AgriInvest. Again, you can do with what you want with it, but you can invest in feed, marketing. These are just options, animal health, or offset cost during market downturns. AgriStability. So again, there's high input costs. So you have feed processing, plus you're carrying that animal for a longer period of time. So you have that kind of higher risk exposure for that. So again, AgriStability could help you with that risk. So for custom and feedlot operators, for AgriInvest, income you earn from custom feeding is allowable based on the value of allowable commodities you grew or purchased and the feed to the custom fed livestock. For AgriStability, when you look at the custom feedlot operators, you can look at income and expenses. They may be allowable if you grew the feed yourself, or if you made an appreciable contribution to the growth and maturity of the livestock. So AgriStability is really here to support the farmer, and that those risks of uncertainty and those uncontrollable things that you can't control, it's not here to support kind of like normal business dealings. So, so if you, I'm not going to kind of like dive in, there's a whole bunch of nuances to the custom feedlot operators. So if there is somebody who is operating a feedlot, and they want to have kind of a one-on-one discussion on what that looks like for their operation, please reach out to me and we can go over how to fill the forms out and how this could benefit. So production units are needed for the AgriStability program. It's on page 2 of your application, as well as on the last page of your statement A or B tax forms. You need to provide the production capacity for your operation. So a lot of farmers don't understand the importance of this data that is needed. So this is how you're telling the federal government what is happening on your farm. So the administrators are not there on a day-to-day basis. Your accountants aren't there on a day-to-day basis. So this is how you're telling them what's really happening and where your struggles are and what's happening financially. So it's really important to kind of be filling this production units outright. When I'm meeting with producers, this is where I'm seeing the biggest errors are at. And some of the time, by adjusting some of these production units to the reality of what was happening on the farm, they triggered a benefit. So if there's any questions that you have, if you're in the program or want to get into the program and need support on this production capacity, again, please reach out to me. I'm here to support you. The slide here is showing the production capacity if you wanted to enroll in the program. And I went through the 40 pages and just kind of pulled out the livestock side of it, and kind of put what you need to track to, because there's a lot of people that I talk to that say they would like to be in the program, but they don't know what data to even track. So this kind of gives you an idea of what you need to be tracking. So again, this is the AgriStability statement A or B form, the last page that I was referring about. Most of you guys would have an accountant that would be filling this out. But again, it's really important to just kind of take a look at it, see what you should be tracking to kind of help you with the better record keeping. So I know that talking to some farmers, and I married a beef farmer, so I know that people don't like paperwork and they want to be out farming, but a lot of this information you should be keeping track of anyways, kind of as farm best management practices. So do what works for you. You can keep a little book in your pocket. You can write it in your iPhone, but it's really just trying to figure out the best way that works for your operation. I am trying to design some tools to help producers track this data. For example, like a year-end inventory checklist for different commodities. But if you have any ideas of how we can help you keep better track of your information, please give me a call, and I really want to try to help because this seems to be one of the biggest barriers for the program. So changes to AgriStability. So starting in the 2025 or 2024 program year, the deadlines have changed to June 30th from submitting your program payments, and then September 30th with penalty. So anybody who is in these programs, they have moved up those deadlines. So it's important to be aware of that. Get your accountant to start filling out those tax forms. And AAFC has offered a tax-aligned reference margin as a choice for producers. So anybody who's in AgriStability got a tax-aligned reference margin kind of sign-up sheet. Where I see the biggest benefit for that is if you're currently not in AgriStability and want to get into it, by going with the tax-aligned reference margin, it kind of reduces some of that original paperwork that would be needed. So that's where I see the biggest benefit. But again, if you are in the program and have questions on if you should enroll in the tax-aligned reference portion, please reach out to me. I can go over your calculation of benefit to see if it makes sense for your operation or not. So I know many are probably following the news with all the tariff conversations and everything to do with the elections. But on March 22nd, they announced proposed changes. So these are just proposed, they're not approved. But I think it's important to know that what could be coming down the pipeline, because in order to take advantage of these 2025 changes, you need to enroll in the program before April 30th. So in the examples that I was going over with you, we were talking about that 80% compensation rate, or the 80 cents on the dollar. So they're looking at increasing that from 80 cents to 90 cents. So once you trigger a benefit, you would get a large amount of money into your pocket. And they're also talking about doubling the payment cap. So right now, if you were eligible for a benefit, the cap would be 3 million. And they're talking about moving that up to 6 million. So again, in Nova Scotia, we have a lot of smaller operations. So that's not I guess a benefit that's going to affect a lot of producers, but it's something that if you're looking at growing an industry, or then you know that is an option as you grow. So I know I already kind of went over an example, but I'm just going to go over another example, just a different way, just so people can really understand it. I know that AgriStability can be a little bit more of a complicated program, but it's once you kind of see it and learn what you need to capture, it looks a little bit simpler. So I'm just going to go over this example. So let's say that the market's been good, but there has been a large dip in price and your feed expenses have gone up. So let's say your allowable income is $150,000. So that would be like, for again, cattle sales. Your allowable expenses would be $100,000, which would make it so your program year margin before accrual adjustments are $50,000. So like I said, accrual adjustments, those are those kind of things that they want to kind of keep track of for your operation. So it really shows a clear picture of what's happening on your farm. So let's say crop inventory changed, your feed value went down $5,000. Somebody owes you money for that hasn't paid you yet. So you have a $7,000 receivable. So that makes your production margin after accrual adjustments at $52,000. So when you're comparing that to your reference margin, so your reference margin is 95,000. So as we said, you have to have a substantial loss in order for this program to trigger. So it's 70% of your reference margin, or that 30% loss. So in this scenario, you would have to have your payment trigger point would be 66,500. And in this scenario, your program year benefit was 52,000. So that shows you that there was a decline of 14,500. So they take that, and right now, like I said, the compensation rate is 80 cents on the dollar. So if your margin decline was 14,500, you'd get a benefit of 11,600. or if those changes, those proposed changes do get approved, then your benefit would be $13,050. So a lot of people are like, that's great, that this is what it potentially looks like. What do the fees cost? The fee to protect your farm is equal to 0.45% of your contribution reference margin multiplied by 70% level. So basically $3.15 for every 1,000 of protected reference margin. So in this scenario here, your payment would be $299, plus you have an annual fee of $55. So it would be $354.25 in order to look at being enrolled into this program at this level and potentially getting a benefit. I do also want to note that there is a minimum fee of $45 for any of the small farms that are online. I'm just going to go. So this here just kind of shows you need to enroll in the program before April 30th. If you've already participated, you would get an enrollment notice from Agriculture Agri-Food Canada. And if you haven't enrolled into it, you need to fill out a new and rejoin and participation form. This is just a 2-page form. Again, I can help you with it. The first page is kind of that cookie cutter data information, and the second page is that production units that we were talking about in a previous slide. You need to pay your fee, an admin fee. So again, that would be paying your $55 annual fee plus whatever the calculation is done for your reference margin. It's supposed to be paid by April 30th or by the enrollment deadline. After that, you would complete your AgriStability form. So AgriStability and AgriInvest works off of your tax form. So you just have to let your accountant know that you want to be involved with these programs, and they're a slightly different form that they would have to fill out for tax purposes. And then they would send it off to CRA. Then CRA sends the data to the administration team to do those calculations. So again, the final deadline for the forms would be the June 30th, would be the initial deadline for next year for the 2025 program, and September 30th, 2026 would be the final deadline with penalty. So here is my contact information. I know it was a lot of information and I talked for 40 minutes, but the biggest takeaway is if you want to learn more about AgriStability, or if you want to start the process of enrolling, we need to do that before April 30th. So my contact information is there. Please reach out to me. I was doing a road show. I've already been to Nepean and Antigonish. I am going to be in Kentville tomorrow, and I am not fully booked yet. So if there are any farmers that are close to that Kentville office, if you wanted to have a face-to-face, please text me and I can set something up for tomorrow.